And welcome to Brain Wealth with your host, Bryan Repple. Bryan, how are you? And what have we got on the table to talk about today?
Bill, I'm doing great. I am wearing my happy purple shirt today. I know these shows, we record them a little bit in advance and they get published a little later. So,
yeah.
Today is March 4th. And so when this...
No, April 4th. This is
April 4th. Yes, April 4th.
Don't get lost in time, Bryan. Come back.
Yeah, April 4th. I'd like to go back to March 4th, but today's just a wild day in the markets. And you always remember these days, especially when you handle clients and stuff. So instead of wearing a red shirt, I decided to wear a purple one and just bring out, say, hey, things will be okay. And we're going to talk about, really, there are things that we can control and there are things we can't control.
Exactly.
And so that's why I'm wearing the purple shirt, because we can't control tariffs or how the market is responding of like what we're seeing today on Friday, April 4th. So we're going to talk about things today that we can control. So it's going to be dealing with taxes, tax strategies, because we just are finishing up tax season. So how we can look forward to the year ahead. And, the idea is, money will go down, up and down in the markets and overall economies. But what are strategies and things that we can control? So that's what we're going to really focus on here today and put our attention to.
So I'm gathering this is a session about tax strategies, right? So where do we start here?
Yeah, so really, I kind of listed 3 strategies ranging from kind of one group of individuals that will maybe be from individuals that have IRAs.
Yeah.
Another one of looking at taking advantage of what is going on April 4th in the current market and the economy. And the last one will be for retirees, those individuals 70 and a half and older, about making donations out of their IRAs. So we're going to be focused around taxes here today.
Yeah, and I know most of your listeners know this, but I'm just going to state the obvious, okay? Because we're doing this in 2025, and as everybody who's even remotely reads any financial documents or news knows, the Jobs Cut and Tax Cut Act is going to expire at the end of the year, and Congress is going to work on it. So we're going to see, or we could potentially see, a fairly significant change in the tax structure in 2026, right? And I think that probably makes this year pretty critical for Roth conversions. And who do you think stands to benefit the most in this particular case?
Yeah, on the Roth conversion, great question, Bill. So really, let's think about this. So you got to really ask I'm going to call it 2 questions. One is, do you think taxes will be higher or lower in the future? I've asked that question many times on this show.
Yeah.
Will it be higher or lower in the future? Your taxes particularly, will they be higher or lower 5, 10, 20 years from now? And if we don't get any tax reform confirmed this year, the 2025 tax changes will sunset back to they were before Trump was in office. So the second question is, would you rather pay taxes on the seed or the harvest? So what if this is the last year to shift money into a tax-free situation for the next decade? What if this is the last year? Now, I don't know if the House and the Senate are going to be all pass reform, but we know that at the end of this year, it does sunset. Yeah. So what this first part of the conversation is the Roth conversion and what that means. So let's start with one of the more powerful and misunderstood strategies that we have available today, and that's that term Roth conversion. So what is a Roth conversion? Simply put, a Roth conversion lets you put or move money from an IRA, which would be taxable when you take that money out. So it allows you to move money from an IRA over to a Roth.
Yeah.
Yes, you pay taxes now. So that's the idea. You want to pay taxes on the seed or the harvest. So you transfer it to what it allows is, let's say you have $100,000 sitting in an IRA. You can move that $100,000 over into the Roth, pay taxes on it today, then allow that money to grow tax-free for the rest of your life. So just imagine it like this. you're at Costco and you're learning your favorite product is half price, but only until the end of the month. So would you rather stock up now or wait till it's full price again?
Yeah.
That's the decision facing investors with a Roth conversion. Taxes potentially are on sale for you. So, but the sale is potentially ending too, because we don't know what the House and the Senate are going to get done this year. Yeah. So that's what I'm using the word potential, because we know that it does come to an end at the end of 2025. So this is a big deal, because I like to think of this as like, hey, there's a potential that this tax is on sale. And this all happened under the Tax Cuts and Job Acts. And so, but unless Congress doesn't, pass something, these tax brackets sunset. So we're getting finished up doing tax returns right now, Bill. And I'm showing clients saying, hey, because of the standard deduction doubling and increasing from the original Trump administration, most people are not itemizing on their tax return.
Exactly.
And so because of that, they're getting this higher standard deduction, which is helping them save taxes.
Yeah.
But if we sunset and the standard deductions roll back to where they were, that's what it's set to do at the end of 2025, we can see potential tax increases go forward.
Oh, yeah.
So I know this is a big, not to get into politics, but this is a push for Trump where he does want to extend and have tax reform. So this is just kind of, I'm laying this strategy out so we can be proactive in our planning. So really ask yourself, the listeners out there, you want to pay taxes on the seed or the harvest, because the window is open now. And if we want to pay taxes on the seed and look at taking advantage of that, we have software, tax strategy planning software that we can look at what is the right number to convert. So one of the things we try to look at, Bill, is everybody has a tax threshold. And so think of it like buckets. If I'm just going to use a simple number so the conversation just stays very basic. So let's just say between 0 and 50,000, that was your bucket, and you paid zero tax. Then 50 to 100,000, you pay 10% tax. Then 100 to 150, you pay 20%. That is not the way it's set up. I'm using it as just in a logical way to understand it. So if you were falling between 50 and 100,000, but your income was maybe 60,000, and you're paying 10% from 50 to 60, well, we could look at saying, well, what if you put between 60 and 100 and you're still only paying 10% tax? So we may want to fill up the additional room in your income tax threshold bucket, so we max out that current tax bracket you're in. I hope that makes sense. I'm trying to make that simplistic.
No. Yes. And you are keeping it simple, which is good.
Yeah. So an individual may not want to be pushed up to the next tax threshold. So we say, all right, where are you falling into now? And if we know where that is, how much room do we have to play with in that tax threshold without going into the next bucket, the next container up? So these are just strategies we want to look at, talk about, and look at saying, hey, do we want to take advantage of that while the window's open, like the Costco example? The product is on sale.
Do you want to buy, or do you want to wait till it goes back up? That's the simple question there. Now, you mentioned tax harvesting. What is tax harvesting and direct indexing, and how do the two of them relate to one another?
Yeah. So here we are, like we said, April 4th, 2025. We've had a week of, we went with tariffs being announced, what was called Happy Liberation Day. We got Liberation Day, and then the next 3 days was not so liberating in the markets. Yeah. A lot of red. The markets were falling off. So what is tax harvesting? So the way I like to kind of ask this question to clients is, what if market dips weren't losses, but they were tax savings opportunities? So think about that. So you and I were just having a conversation, Bill, and you're like, hey, Bryan, with the markets being down, what are, my portfolio is taking a hit. And I said, well, this could be an opportunity for you to sell while the markets are down, some of those positions, to capture those losses. So are you managing the taxes on your investments, or are you just riding the wave? Most people most clients, most individuals are just riding the wave. So this is not for IRA or Roth IRA accounts. This is for your, what are called your non-qualified. Those other accounts are called qualified. Okay. So these are your taxable investments. So the idea is when the markets are down like what we're seeing, there's a potential opportunity. I use that word potential because it's relative to your situation.
Yep. And
we say, all right, are there losses in your accounts? No, obviously we don't like losses, right, but they come with everything. So instead of just letting the loss be there, tax harvesting or taking advantage of tax losses is an advantage right now. So there's a chance that you can look at a portfolio and say, hey, so let's just use Tesla stock just as an example.
Right.
So you may say, all right, my Tesla stock's down. Meta, NVIDIA, those are technology names. Apple, Google. So those are technology stocks. They are down ranging 20 to 40% right now, those companies. So if you owned companies like that, you can say, all right, what if we sold them right now? We captured the loss from the sale. So now you took the loss and you have it sitting on your tax return going forward in 2025. But you still really like those companies. What could you do? Instead of going back and buying those same individual companies, you could go buy an index. You could go buy an ETF that owns those same companies. Now you're selling when the market's down. You're going to be buying when the market's down. So now you're going to, obviously, I think those companies will come back. We're having a sell off. And again, it's at a discount. So when those companies do come back up, well, you're going to have gains in there. So what do you do with gains? You have those losses that you took advantage of to help offset those gains in the future.
Yeah.
So, because what do most people do? They ride it, they hold it and they ride the wave, and then they go sell out in a period of years and they have gains back in their accounts.
Yeah.
And what they say is, well, I don't want to sell it now because I have gains. But what if you now have the freedom to sell that asset in the future because you've took advantage of those losses when the markets were volatile during this period of time? And that's what we're looking at right now, is how to capture and be strategic with tax loss harvesting and potentially what's called direct indexing. So here's just a story is, I kind of just gave it, but there was a client that was tech heavy in their portfolio. Okay. And it took a hit. So the idea was just what I went through. We decide, hey, instead of you had big capital gains, those gains now were basically, it's like a wave. The wave came in, went on shore, and now it got washed away. Yep. So we're like, all right, now we still want to own those positions. The clients still really liked all those positions. And by showing them the strategy, say, hey, let's sell now. We're not selling them and saying we're never going to buy them again. Right. Let's sell them, capture those losses, but let's go buy them back in an ETF or in a different position that still owns those same positions.
Yeah. Yeah. And because, just for those who are listening who don't know, you can't just capture a tax loss in a stock and then turn around and buy it the next day. There are rules that keep you from doing that. So what you're saying, Bryan, is, okay, you can sell those technology stocks, maybe in this example, that hurt you, and you could go buy them back, in essence, by buying the index that has them all in it, right? Is that clear?
That's correct. That's correct. Yeah. So like sometimes what we may look at is someone owns McDonald's or let's use Home Depot, an easier one. Yeah. So like, hey, they've owned Home Depot for many years and Home Depot has now captured a loss. Well, we can sell that and go buy Lowe's. You're in the same industry, same sector. Or instead of Lowe's, you go buy the index that owns the same type of stocks that Home Depot is falling into. So yeah, we want to avoid what's called the wash sale. That's just like you wash your clothes. Yeah. So if you are selling and buying the same stock within 30 days, you have this. So just a tax rule. So the whole idea is being strategic. So it's not saying, oh, the market's down. I have no strategies. Well, wait, there are strategies. Let's look at, are there losses that we could be capturing right now for your future.
Turn them into your advantage, as it were. So what is I want to go to this next question because you talked about QCDs. What is a QCD?
Yeah. This is kind of an unheard of, and it's not talked about too much. So this is the strategy. The previous two strategies are open to everybody. Mm-hmm. Anyone that has an IRA wants to go to a Roth, pay taxes now, capture your stock losses is the tax loss harvesting. The third strategy is for individuals that are 70 and a half and older. And what the government allows is for any individuals that are 70 and a half and older, and they're donating and giving money to charity. So what if you could give in a way, when I say this, give in a way that saves you more in taxes? So let's kind of walk through this. So a QCD is what's called a qualified charitable distribution. So all that means is you have individuals that are taking money out from an IRA because they're forced to. They're taking money out from the IRA, or they're being forced to through their required minimum distributions. So they're taking money out. Then they go along and say, gosh, I have this church, this ministry, this special cause I care about. Then I give that money to that organization. So let's walk through that. When they take money from their IRA, they're paying taxes on that money.
Okay.
Because it's a distribution. And then when they go give the money to the charity, they may not be getting the tax deduction because they're not itemizing. They just already get the taxes with the standard deduction rule. So they're withholding taxes from that distribution. So what the qualified charitable distribution rule allows is, again, for 70 and a half and older, up to $100,000, you can take an IRA distribution directly from your IRA and give it right to the charity and avoid having to pay taxes on that distribution. The reason why that's really important is because when you take that distribution from the IRA, it goes into your ordinary income, it goes into your taxable income, which can force your Social Security to become taxable, as well as your Medicare. So by skipping that part of the process and going from IRA to directly to the charity, you avoid increasing the taxable income on your Social Security and potentially your Medicare premiums. So, and that's up to $100,000. So individuals 70 and a half and older that are charitably minded, this is just a neat strategy that we like to present to our clients that are that age, saying, hey, let's minimize some taxes that you're owing on these dollars and still be able to give to your favorite ministries that you have out there.
That's cool. I like that. That's really great.
And listen, we don't want to work harder on our money. We want to work smarter.
Yeah.
And this is keeping the money. Taxes are some of the largest expenses you're going to face over your lifetime. I mean, that's taxes. And you're going to really see that more in retirement or in that next stage of life because so many people have money in their IRAs they're pulling out. So we don't want them to get a surprise with a tax bill. And if we can help them, reduce their Medicare premiums, not pay taxes on Social Security, then that brings their overall taxes down. So these are just some strategies that while the markets are being a little wonky right now and the economy's doing what it's doing, let's look on things that we can control. And taxes is definitely one of them, and being strategic. That's why, Bill, we always kind of want to, as much as I love and I enjoy the market and I enjoy having those conversations, I want to hang my hat on. And I believe what we really focus on as a firm is about planning, taxes, and the journey that the individuals are on. Because the markets are always going to go up and down.
Yeah.
And starting off this call, I was talking to someone else that, man, you'll always remember these days. I remember March 2009, the bottom of the markets. I remember where I was in 2008 when the markets started the decline of the Great Depression we went through. And it's going to be April 4th will be another one of like, oh, we'll remember where we were. I will, because it's so important. But those are things we can't control. Yeah. Can't control those things. So we want to really always be focused on the planning and the process and the strategies for our clients and getting them to where they want to be in the future.
Yeah, that's great. For anybody who's listening to this podcast, Bryan, and thinking they might want to have a conversation about you because they find some of this interesting, what is the best way for them to get a hold of you?
Yeah, awesome. Thanks, Bill. So that would be reach out to us. Websites, Repple, Repple, wealthgroup.com or email myself at Bryan, Bryan, at GAREPPLE.com.
Yeah, and don't worry if you didn't have a pencil to write all that down because it's in the show notes, folks. So it's easy. You can look it up later when you have the opportunity and the time. The other thing you can do, this doesn't really require much effort at all, is if you're not a subscriber, become one. Just hit the subscribe button because every time Bryan drops a new episode, you're notified. You can give it a listen. I would also ask that if you like the podcast, tell people about it. Rate it. Give it a good rating. Let people know. Word of mouth promotion, particularly in these days when so many weird bots and strange things are online recommending who knows what. It's just nice to hear from somebody that says, hey, I like this podcast and this guy's interesting. And we would very much appreciate that as well. So until next time, I'm Bill Tucker on behalf of everybody at Repple Wealth Associates and on behalf of Bryan. Thanks for taking the time to listen today. And do remember this, you can go out today and make today a great day or not. The choice is yours. Until next time.
Thank you for listening to Brain Wealth with Bryan Repple. Click the follow button to be notified when new episodes become available. Visit our website at www.repplewealthgroup.com. That's REPPLE wealthgroup.com. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Bryan Repple. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Bryan Repple is a registered representative and investment advisor for G.A. Repple & Company, member of FINRA SIPC.